If you are not sure how we value inventories, this video will explain the 4 cost formulas we can use, and in particular the 2 main ones, FIFO and weighted average. Inventories are valued at the lower of cost and net realisable value. What we expect we can sell the item for, less the costs of selling it. We usually expect net realisable value, that is market value, will be greater than cost, so we can make a profit when we sell the item of inventory. So we usually value inventories at cost. Valuing our inventories at cost can be a little bit tricky in practice because different items of the same product in inventories may have been purchased for different costs. Bunnings, a subsidiary of Wesfarmers, sells a Ryobi 1 Plus 18V cordless compact drill. Bunnings may have thousands of these drills in inventories across Australia, and they may have a range of costs, for example due to movements in exchange rates. So we need to decide the cost of the items of this product that are sold and the costs of those still held in inventories. To deal with this issue, we need to use a formula to measure costs. There are 4 cost formulas we can use: specific identification, first in, first out, FIFO, weighted average, and last in, first out, LIFO. With specific identification, we attach the actual cost to each individual item in inventories, and we track each item from purchase to sale. With improvements in technology, this is becoming increasingly feasible. The accounting standards prohibit specific identification where items of inventory are interchangeable. This is to ensure management are not able to use the specific identification cost formula to manipulate their profits in a period. So we usually need to use one of the other cost formulas, which requires us to make an assumption about how costs flow through our inventories: FIFO, weighted average, and LIFO. The international accounting standards prohibit LIFO, although it is permitted in the US. This means our firms, which are all using international accounting standards, have 2 choices: FIFO or weighted average. Except, of course, for a few limited cases where different items of a product are not interchangeable. In these cases, firms must use specific identification. With FIFO, we assume the first items purchased for each of our products are the first ones sold. This means we assume that in our inventories, we will always have the more recently purchased products. With weighted average, we use a weighted average of the cost of individual items of each product in a firm's inventories. How this is calculated depends on whether we use perpetual or periodic methods to record inventory transactions. If you would like further information on how we value inventories, go back to Chapter 4 in the study guide and also review the Inventories Weekly Questions. Also answer, write and rate questions on inventories in Peerwise.